This is basically the equivalent of a tsunami of freight coming to the Port of Los Angeles.
Hey guys, welcome back to Shifting Gears. My name's Grayson Harris. That's Henry Byers over there. Our top news story for this week is going to be Hurricane Beryl. Obviously, that's a pretty big deal. First hurricane of the season. Made landfall in Texas just earlier this week. Ended up leaving millions of Texans without power, and some in Louisiana as well. Some of the estimates were saying that there's about 2.5 million people that are without power. Some of that's coming back, but restoration efforts are tough because it's like 105 degrees over there. So that keeps putting a hamper on things. Talk about a double whammy, man, getting hit by a hurricane and then baked in an oven, like, days removed from each other. But, obviously with the damage that it's done, it's going to have an impact on the supply chain as a whole. Some of the ports in the area closed down in anticipation of it. Not any crazy damage from what we've seen. As a matter of fact, like Corpus Christi opened like the day after, essentially, which is good because they're the U.S.'s leading crude oil export hub. So obviously important to keep that thing running. So overall, the Texas ports pretty much dodged a bullet there, but obviously there are still going to be some ripple effects. Some are, a bit more immediate than others. Some are going to take a little bit longer to see than some of the others. I also think it's an important thing to mention as well that this is just the first hurricane of the season, and it holds the record for the earliest Category 5 hurricane ever observed in the Atlantic Ocean. So we're just getting started. There's going to be plenty of other opportunities for these storms to disrupt things and really throw a wrench into the transportation market, and kind of goes into what Henry's been trying to tell y'all for a little bit is like, it might be getting a little volatile here in a little bit, and things like that are going to expedite the process tremendously. So, Henry, I guess that leads into the first question is, what are some of the, immediate and long-term effects from this storm that you've noticed?
I brought in a video from NASA, and I think it shows the precipitation that Beryl brought with it. And I think you're how you put it, dodged a bullet really is appropriate. I mean, there's certainly some damage. That's not to downplay the significance of the damage that's been done. Right. But just in regards to what could have happened, this is really an important economic center for the U.S., the port specifically for containerized freight, which is what we primarily focus on because a lot of that relates to the dry van truckload market.
Exactly.
Certainly is an important port for a lot of big importers like Walmart, as an example, who have shifted a little bit of freight maybe from the East Coast, found the Gulf Coast to be a bit more of an advantage to bring freight into. Now that it's, there's obviously been some expansion there, and there's been just as ports increase in size and populations start to move around a bit, and certainly post COVID you saw some population shifted, especially towards Texas. Texas was one of the big beneficiaries of that, in the Southeast in general, but the Gulf Coast has really become an attractive option for a lot of those shippers. But the rainfall here, I mean, we're really looking at 8 to 12 inches in some places. Mm-hmm. That's significant flooding. And so when you're looking at what is the primary factor of a hurricane as far as how it can be disrupted to the freight market, it's mostly flooding. I mean, obviously the winds can damage quite a bit, knock power out. Like you'd mentioned, there's still around a million, I think, as last check. But essentially, the flooding is what causes a lot of the biggest problems post-hurricane. And I think that's led to really what we've seen in rejections. I mean, what you would typically see is you'd expect, trucks to have trouble getting in and getting out of, an area that's been impacted by a hurricane. And so when you look at Houston, outbound tender rejections are in white, inbound tender rejections are in yellow. I mean, essentially, you're seeing, the rest of the country, outbound tender rejections are starting to come down a bit, after the July 4th holiday, but they've certainly remained elevated here in Houston, and then inbound tender rejections. So it's harder to get into there. And certainly the contracted freight that's scheduled to go into there, some of those carriers may be looking at, maybe getting paid a bit more to go into Houston, because it is certainly not somewhere you want to be. Like you mentioned, it's kind of an oven post-hurricane with flooding. Certainly a pretty big nightmare for a lot of folks down there. So our thoughts and prayers are with those people. Mm-hmm.
So obviously the rejections are going to go up in the wake of a hurricane or any sort of disruption of that nature. And as you can see, that's where it's going on here towards the end, the last part of this graph here past July. But as you can tell here in June, it was already making a pretty big spike right there. What do you think that could be attributed to, if not, something disruptive like a hurricane?
It just speaks to the shift in freight that I had been mentioning. I think if you looked at Houston's overperformed or outperformed most ports in terms of year-over-year growth and containerized freight. And shippers, that are as large as someone like Walmart can really be, a main driver of these shifts that you see in volume. And so there was certainly, a good amount of volume coming out of Houston. There was also that derecho that went through. Mm-hmm. So Houston actually, was already battling a significant disruption in the form of like wind and a severe storm that came through there and knocked a lot of windows out of a lot of the big skyscrapers there. But I think generally that's what we were seeing in some of the other larger markets. And Houston is typically, the 6th or 7th, maybe sometimes it varies, but with some other, large outbound, volume markets. But certainly Houston's been growing significantly in size, and those rejections were, somewhat severe weather, but mostly just a factor of the amount of volume that was coming out of there at the time, pre-July 4th volume, which is mostly moved in mid to late June.
So I guess, and moving off of that a little bit, then what are some of the signs, kind of building off of what we were talking about last week, or the week before, I should say? What are some of the updates you can give us as to what we were talking about last time in terms of what you're seeing now about 2 weeks later?
We certainly want to look at demand. Demand has been unexpected. I guess it is somewhat expected, but at the same time, it's surprising, I should say. If we're looking at dry van volume specifically, just kind of tagging along there with what we were saying about Houston, volumes in June were very strong. If you look at what's going on from a macroeconomic perspective, consumer demand, look at personal consumption expenditures, things of that nature. Here's some surprising numbers. So consumers, where they were expected to spend less, are actually, maintaining or increasing spending in some regard. Certainly, it depends on which sector you're looking at, but volumes, as those volumes get depleted from customers, buying those items, they have to get restored. So a lot of this volume was a lot of this replenishment downstream of inventories that have been, reduced, and we'll touch on some of that here in a bit. But dry van volumes, leading into the fourth, we're very strong. Kind of trailing off there at the end, right before the holiday, but still, we expect to see, a significant rebound here in the next couple of days as this chart has time to, get that post-holiday hangover out of its system. How much of those tenders that are going out are getting rejected? Very much a great measure of how much of that freight is staying under those contracts. Very good, the leading indicator for spot rate movements. What we're seeing, in outbound tender rejections, just looking at all modes combined, you're really right on those 2019 levels, which is in red or orange there at the bottom. And I wanted to show this because I think the dry van market is already overperforming. If you look at all those modes combined versus, dry van by itself, the dry van market's certainly overperforming the other modes at the moment. And this just, you want to look at why it's 2019 different from now, because there's so many things you go back to and say, this is 2019. It's kind of that key benchmark, right? It takes all those COVID years and removes them. Well, this is one way already. And this is why, this is my, big part of my thesis moving forward in the second half, is that we're likely to see an overperformance in the dry van sector, and why that could help, support those other modes as well, just in terms of, the market tightening up. It's a really great point right here, because this is measuring dry van spot rates, right? If you were to see a significant surge in this, my thesis about, it's helping kind of support those other modes of transportation. And generally speaking, when the dry van sector's hot, the economy is typically doing, fairly well, right? You do have housing. The Federal Reserve keeping interest rates high. There's been some sectors that have been certainly, hurting more than others, and flatbed is a big beneficiary of those types of industrial production as another. But looking at specifically about dry van, this is another place where, you're seeing, overperformance over 2019, obviously. But really my point here is that demand, staying at the levels that it has been at, and maintaining those spreads over, previous years. From a demand perspective, demand is there to take the market, much higher in terms of where the spot rates are. It just really comes down to capacity. We've been talking about overcapacity for quite some time. We have some good insight from FreightWaves on that here in just a bit. But when we look at how that relates to contract, what we're looking at here is in white is contract rate levels for dry van per mile versus what you're seeing in the dry van sector with, basically the DOE's, benchmark for fuel, diesel fuel. And you've seen, basically we're on an upward trend here. And we saw really some outperformance or performed over expectations heading into July 4th. I mean, we saw tender rejections hit levels that they hadn't seen since that midpoint in 2022. And so I keep coming back to that point in 2022 because I think it's really interesting to think about. If you were to see spot rate levels go to where they were in mid 2022, if you were to see contract rate, I mean, we're talking about a significantly different market in terms of the health, what the revenue carriers are earning. Now, there is two perspectives on that. Would that be enough to kind of keep these carriers in the market? The carriers that probably should have, been bled out of the market by now, potentially. But it's one of those things where there's not a lot of pressure. We talk about that pot on the stove. There's not a lot of give in this market. If one thing happens, that things build up in one market, the way it can suck capacity can really impact things significantly. So, I mean, I really am looking at rates to overperform. I think there will be a catalyst. There's a number of things we can touch on, but essentially, if all things stayed the same and there weren't that many more carriers than have been for the last 2 years bleeding out each week, then essentially I think we still have a case to be made to make those mid 2022 levels in terms of spot rates for dry van market.
So it's starting to swing at least a little bit more into the carrier's favor, but there's also, since 2 years ago, a lot of carriers leaving the market, net changes and things of that nature. So what are some of the things that you may expect to see if spot rates are keep going up, or is there something else that maybe would affect the net number of carriers here in the near future?
We talk about benchmarking to 2019, right? I mean, this is largely a reason why what happened there with volumes. There's some data points we'll touch on here in a second that look very 2021-ish in the ocean market. But essentially from, over the last 2 years, really back to July 2022, the average carriers leaving the market is about 352. The last week was 630, but the previous week was 199. So if you look at how that average, that's the most meaningful. But I think that is a pretty significant decline here in the last week. And so I think what you're having is this has been a very prolonged down cycle. It's been abnormally long. FreightWaves came up with some interesting research on that, but really the whole point is what's keeping carriers in the game. Is it technological improvements? Is it efficiency? I think what we're going to see is that just how high spot rates, the amount of revenue, and honestly the amount of government funds and loans that were given out during that time period has also been a contributing factor. And I think that's where FreightWaves digging in with the Small Business Administration has come up with some really unique insights into helping explain how this would be possible. And you would expect to see almost an equal but opposite downturn in terms of how many negative carriers, right? Like you would expect to see a massive with how depressed spot rates have been. So it's really been interesting to watch. But again, my point is, even if this maintains, I think there's still room for those spot rate levels to get back to where they were in mid 2022, especially in some really key markets, specifically Southern California typically drives a lot of what we see in the dry van truckload market. And I think the conditions are ripe to see Southern California overperform, and it already was prior to July 4th. I think we're going to see some trends continue upwards as we move into back to school season and then peak holiday retail season.
So what are some of the things then that were in that report that kind of caught your attention of how these carriers are able to stay in the market and stay in longer than most would have expected? Yeah,
so this article came out today, really from John Paul Hempstead. They did some digging into the Small Business Administration, trying to get an understanding of, okay, there's not a lot of transparency, I would say, in data, because this is all, number one, COVID was, pretty much a black swan. So there wasn't a lot of the things that were, provided during that time were really unprecedented. There's not really a great, central place for here's our black swan event. Here's how we're going to deal with it. And here's all the data to keep track. So really they ended up filing what I would imagine as a Freedom of Information Act on some level, whether that was truly that, how they basically, drew it out and submitted it, the request. But essentially they were able to get to the Small Business Administration and how much money was really given to specifically the North American Industry Classification Codes 4849, the transportation and warehousing sector. So what's really interesting, $37 billion went to some 37 billion across 419,500 loans. And the loan average, for an average loan amount, and this is just taking that average, right? Because there's, again, not a lot of transparency here about how much was given to each one, but of $88,200. When you beginning in March of 2020, small businesses could get loans of up to $500,000 on 30-year terms at a fixed interest rate of 3.75%.
That is not bad.
That is exactly.
That is not bad at all.
So somebody, yes. And I would say, between you and I, between our ages, there's a lot of people looking at the housing market. A lot of people have bought houses in the past few years.
Or like me, I can't.
Or trying to. Exactly. Yeah. So it's one of those things where in September 2021, that ceiling, so instead of 500, went to 2 million. And then by January 1st, they basically, probably shouldn't, continue this on any further.
Raised to 2 million on 3.75%.
That's what the article led me to believe.
My goodness.
Yeah. So if you look at, they were talking about basically 20-year Treasury, you're basically looking at 4.5, a little bit over %. This really becomes viewed as free money for the taking. I mean, it has to be repaid, obviously, but when you're looking at that spread, I mean, it really is one of those things where it's an attractive thing to do.
Yeah.
The transportation and warehousing sector is comprised mostly of small businesses that employ 1 to 4 employees. So we talk about these small carriers. We talk about how fragmented the dry van market is. So if you look at the 723,000, a little bit over, total businesses employing 726,238 people, of those working in that sector of transportation and warehousing, 539,000 of that 723,000 are firms with 1 to 4 employees. So when you're talking about 58% of these companies receive these COVID, economic injury disaster loans. You're really talking about a very significant. And so what JP Hampstead had dug into was really this 37 billion is beyond operating income as for the entire sector because of the thin margins that's made in this industry. So really, really interesting. But I think it really, in my mind, solidifies the fact that, okay, what did we know? We know that the revenues were high, spot rates were high. I mean, really unprecedented levels. But really, in reality, why have they been able to hang on so long? I think this is one of the, primary reasons why. What JP ended up finding out or hypothesizing, I should say, is that the chickens will come home to roost. And so when you talk about how this would impact the transportation sector, depending on that timeline of so these things are becoming delinquent now. So now the Small Business Administration is not set up to go in and recoup these loans. I bet there's so many of these carriers who either don't know how to pay them or literally can't find anyone to contact about the appropriate way to do it. So these have been this SBA has said that they're turning over a lot of these delinquencies now to people who can handle them. Who's that? The Treasury and the IRS. So the IRS set up to start recouping this money. Well, there's things that they can do that are beyond what the SBA has the capability to do in terms of pursuing these loans.
Right.
So I would expect to see, and that may be one reason we saw a pretty steep decline in this last period. But you're going to find that, what was put up as collateral. So this is another interesting point. They were able to put up their houses as collateral on some of these loans. And then I think in the event that they didn't, they were able to put, even their trucks up as collateral. And so the chickens may be very well coming home to roost in the next, this next half of the year. The assumption is that this is going to have a dramatic impact on capacity regardless, right? So so we're basically saying if it stays the same, there's a case to be made for the, dry van market turning up in terms of spot rate increases. Well, imagine that happens, back here. Well, that just means a further escalation of rates, right? So we could be looking at another pretty major cycle, and it's really a post-COVID relief, kind of that whole...
Like an aftershock.
Yeah, exactly. An aftershock. So much like you talk about the bullwhip effect, another whipsaw, a capacity shakeout that could be pretty significant. And I think if you talk about that on the heels of and what we're going to talk about with imports, you could really be talking about a major escalation in spot rates. The Logistics Manager Index, Zach Rogers and the crew over at Colorado State, I think are helping to explain what's going on with the inventories right now as well as anybody. So what we're looking at here is warehouse utilization in white. So he noted, and it is a very it's a noisy part of the index, but this is the Logistics Manager Index as a whole is a composite of all these measures. But these individual ones, in my mind, help kind of understand what's going on in specific portions of that space. So warehouse utilization in white took a nasty dive. So if inventories were running lower, right, this has been our thesis, is that there's become, after COVID, this just-in-case inventory management style. Well, that's costly, right? You can end up with an enormous glut of inventory if consumer demand drops off. Well, just-in-time inventory, you start to see these periods where the consumers outperform their expectations. Now you're running low on inventory. Now you have to recycle. Well, so you're starting to see much more exposure to volatility. So if inventories were low, which we're showing in green here, they have some really specific things about how that's broken down between upstream and downstream. But regardless, it's in contraction. So warehouse utilization should come down if it's in contraction. There's less inventory. Those warehouses are not as full. It comes down.
Yeah.
So those are two clear signals that there is a need for more inventory. So you would expect to see containerized import volumes start to boom. But more specifically, at those inventory levels, one of the interesting things they found is that they contracted in the first half of the month 40.5. That's a major contraction.
Yeah.
Before turning it around into an inspection of 51.7. The upstream and downstream. So if you're talking about just in time, you're talking about the upstream firms, the downstream firms, you're talking about e-commerce, you're really talking about downstream bleeding their inventories lower would mean that they are moving back to that type of inventory management style just in time, right? So more exposure to volatility for what we're trying to really, our thesis around, the increasing exposure or the pot on the stove getting ready to boil. Largely driven by upstream, who slightly increased inventory levels to 51.5, so increase.
Right.
A sharp contrast to downstream firms who saw inventories contract to 37. That's an extremely low reading. And then ultimately their conclusion. Downstream firms running inventories down while the upstream counterparts build them up likely signals that retailers are attempting to maintain just-in-time management and keep costs down while their upstream partners begin the need to build up for peak season.
Oh, interesting. Okay.
So what would we expect to see with all that? So I'm going to plot Logistics Manager Index inventory levels
here we go.
with imports. This, my friend, is a huge part of my thesis around things potentially turning up more than some expect in the second half. Those levels are, amongst the post-pandemic, that 2021, extra stimulus money. I mean, you are really looking at a significant and a very healthy inventory rebuilding cycle. What I'm hypothesizing here is that this will come in and help replenish those inventories. There's some, there's theories around rebuilding or pre-building for peak season, maybe circumventing some of the potential volatility and exposure they may have around the election time, but essentially I think this is likely to continue. So if you're looking at peak season, that typically runs, you really could say July through September, but it's been we haven't seen a normal peak season in quite a while, but I think this is getting back maybe to a more normal peak season. So you're looking at inventories building up ahead of the holiday retail season, back to school, etc. So I think we could maintain these levels more than most expect for the next month to 2 months.
Okay.
So that then boils down to which ports are handling this volume.
Yeah.
And so what's really interesting is you start looking at container rates. And again, think about the need to even get ahead of these container rate increases. So you're basically saying if you were shipping volume in May, that you're paying half, a little less than half of what you're paying today.
That's 2 months, by
so
the way.
So white is China and East Asia to the West Coast. Yellow is China, East Asia to the East Coast. We'll look at where West Coast is relative to East Coast. Which one is above? Again, back to the mid-2022, we're already overperforming. And so if you look at how the pressure builds, we used to say it would build from East Asia to the U.S. on that initial part of that bullwhip, or in this case, this is another cycle of a bullwhip, but essentially a rebuilding cycle of inventory. Yellow's not past where it was in 2022. Well, you had the port labor negotiations that now look like they could become an issue in the latter part of September if they're set to expire. Much like you'd had it on the West Coast, you saw freight get pushed to the East Coast. Yeah. Then you saw the Panama Canal. Then you saw the Red Sea. So there's been some shakeups back and forth, but they usually, if one gets over flooded with volume for whatever reason, it typically you see a shift and vice versa. So this is one of those things where it's also, things are getting back to normal, in my opinion. Like I would have expected to see West Coast overperform. It's closer to China and East Asia. It's, that shorter transit time and the amount of volume that it can handle and the amount of infrastructure that the Inland Empire commands. It's just a much more efficient way to move freight, from China and East Asia in those just-in-time management styles. And so when you're looking at Los Angeles, well, what would you expect to see? If we're overperforming, you'd expect to see volume.
Right.
You wouldn't expect to see carriers just squeezing people, squeezing companies just to, push rate higher. I mean, there has been, capacity issues because of the Red Sea, Panama Canal. But at the same time, even though that congestion is building, carriers come under fire pretty quickly for just simply rejecting, freight outright. It has to be good reason to increase these spot rates, right, for those guys, because there's only 9 command, 90% of the trade. Look at Los Angeles. And I wanted to show you this not only in context of the last year, but I wanted to show you in context of where it was in the pandemic. So look at when you had really import volumes at their highest levels ever. Port of Los Angeles specifically, this is just the port of LAX. This is not showing Long Beach, but Long Beach is up there as well. It's just, they tend to oscillate, right?
Right.
Volume comes into one, but they're booming in both. So for the Southern California truckload market, this is basically the equivalent of a tsunami of freight coming to the Port of Los Angeles. And this will arrive, so this is looking at the departure date. This will arrive in about 15, 25 days to the West Coast. Because you got to think a lot of that, if you're averaging out those transit times, the majority of those come from China and East Asia. But how does that relate to truckload? Last time we hypothesized that if we were to see rails, which is in white, rail volume, international container rail volume leaving Los Angeles. So we last talked at this point that we would expect that to drop and drive-in volumes to increase if, what was true. Shippers had more urgency around this freight. They needed that inventory quicker because consumer demand was staying, was outperforming. Then the rails, they start to get a little bit congested. So the congestion that's building overseas, Singapore, Shanghai, all these transshipment ports that are predominantly, handle the Southern California freight are already backing up. Congestion's increasing, not decreasing. Now you may see schedule reliability, which is kind of a crazy metric because it's like if they push out their schedules and they increase the transit times on their schedules, well, what happens if I tell you, if I'm say I'm gonna be 1 day late and I end up being 3 days late, but then I say, okay, well I'm gonna be 3 days late now. What happens to my schedule reliability? I'm still late, but I'm on time.
It's just an update.
Exactly, right? So this is important to remember when you see that, because I think they use that as almost maybe a little bit of almost like a propaganda thing to try to make it look like they're actually performing or outperforming. But essentially, this freight continuing to pour into Southern California will, in my mind, only cause more of this. So transloading, moving it in truckload, and really just seeing Southern California suck in capacity. I mean, there was a period there where it seemed like carriers were all flocking to Southern California, and I think they are. I think they still are. Where you may see some rate pressures there, relief periodically, but it'll increase rates in other places, right? Because it's sucking capacity in. Everybody wants those longer haul miles. And sure, that was very advantageous for July 4th. But the problem is that this is now moving into truly peak season for ocean freight, but then it's going to be peak season for truckload there soon after.
Yeah, so it sounds like to me in about a month or so, we're going to want to check back in California and just see how crazy it's gotten. Because, like you said, tsunami of freight coming in, which, by the way, love that as a saying, a tsunami of freight. So
I created this index, and it was based upon, we needed to see further upstream. We needed to be able to see the freight as it leaves origin. So when in 2021, when really imports overperformed expectations, flooded, the U.S. market, and ended up causing a further escalation of what was going on in truckload. This was, that was the tsunami to look. So we really saw it battle tested then. We saw it battle tested during the downturn of when inventory glut became a real problem in 2022. So you saw that freight recession very much triggering in there. And so it's one of those things where this is lived through multiple swings. And so it can be trusted as far as what it's saying about U.S. import volumes from a containerized freight perspective. And I think the longer that takes to get here, the more problem it's going to cause for the surface side markets, specifically the rails, because the rails, we all know, in periods where it's softer, they come down on their rates. The customers can afford longer transit times. Sometimes they just need to store the inventory in something like a container and sit it on the rails for a week or 2 weeks. There's usually more flexibility around those containers. They're not owned by the ocean lines. In a case where you're coming on peak season, you're coming on volatility potentially with the election, you really could be looking at a period where a lot of those imports are exposed to the truckloads, or truckload sector is overexposed, vice versa to those imports.
Wow. All right then. Well, I guess to sort of kind of put a bow on everything, what is the main thing that you want people to take home from what we kind of talked about today with the inventory levels that we're about to see and how that affects the truckload market? What are some of the main take-home points that you just want to drill into their heads real quick?
Don't downplay the significance of containerized import volumes coming in specific key markets like Southern California during a short period of time. I mean, you saw the ships off the West Coast in 2021, 2022. I'm not saying it's going to be that many ships, but that much freight coming into that part of the country at one time can certainly suck truckload capacity in pretty quickly, because a lot of that freight has more urgency around it because it's been delayed at transshipment ports. It's been congested. It's now is bouncing up an ETA that must be met for customers. So a lot of times that freight ends up getting transloaded, hits the truckload market, or goes by dray to the warehouse and gets put in a truckload. Neither here nor there, that freight is going to be overexposed to the truckload sector. And so the rails dropping off in volume, that type of thing, I think don't underestimate the ability for that import freight to affect the truckload sector, and therefore spot rates in the dry van market are expected to overperform most of the expectations, in my opinion, based on what I'm seeing with these import metrics.
That'll just about do it for today, man. That's a great update. I love the progression already, just in the 2 weeks that we've already talked. We're already starting to see the pizza puzzles. Pizza? What? the puzz? The pizza. The pizza.
The pizza puzzles.
I'm hungry. Okay, it's lunch.
Yeah.
The pizza puzzle.
We got good fellas downstairs.
Yeah, exactly. I'm about to just go downstairs and take down a whole pizza and forget that I ever said any of that. See the pizza puzzles. Pizza what? Henry, thank you for that update this week. Guys, if there is any more information that you want to see from us, if you want to learn more about what's going on in the freight market right now, go check out our social media accounts. It'll be down there in the description. We also have our website there. If you have any shipping needs, transportation needs of any kind, you can go get a quote down there, talk to one of our freight experts. As you can tell, we know what we're talking about. I mean, come on, look at this guy. Smart guy over here. Thank you guys for joining us again. Our thoughts and prayers go out to everybody down there in Texas, Louisiana. And, like we said, hurricane season's only going to get worse. So y'all stay safe out there. Be prepared for anything. And we will see you next time. Bye.
See ya.